Dear students, I have come with a new module, Final Accounts Module 11. We are discussing the adjustments for final accounts. So in this module, I will explain bad debts provision and provision bad debts and provision for bad and doubtful debts. So these are two important concepts I am going to explain. Now this term is quite familiar, bad debts. Bad debts, we know that meaning is irrecoverable debt. See, for any business, they have to do credit sales because if they'll insist on cash sales for entire transaction, they cannot improve their sales. So usually the business regular suppliers and all, they may have to give on credit. Some amount which is outstanding may not be able to collect it. So it will become bad. So that is the meaning of the term bad debts. So what is the adjustment? Two options are there. One is bad debts will be given in the trial balance. Then it will be debited to profit and loss account alone. But another thing is that it will come outside the trial balance. That meaning this was not able to adjust with when they are preparing the trial balance. So it is noticed after completing the trial balance. So it will appear outside the trial balance. So then also you have to remember that this will be debited to profit and loss account. And one more adjustment will be there since it's appearing outside the trial balance. Two adjustments. One is either in the trading and profit and loss account or in the balance sheet. So first one is it will be debited to profit and loss account. Second one is adjustment. It will be subtracted from debtors in the balance sheet. So now let us illustrate with one problem. From the following trial balance, prepare the final accounts of Mr. H as on 31/3/22. Name of accounts, capital 70,000, purchases and sales. Debit balance is 89,000, that is purchases. Credit balance is 1,30,000, that is sales. Opening stock 52,000, returns inwards. That meaning purchase returns. Returns inwards is 2000, returns outwards is 1200. Salaries 9500, trade expenses 4100, carriage 1000, bad debts 460, discount 700. Now debtors 71,500, creditors 39,200, insurance 440, fixtures and fittings 3,700, machinery 5,000, rent, rates and taxes 7,100. Bank overdraft, it's a liability that will come in the balance sheet, 7,900. Drawings 2,900, cash in hand 300. Total of the trial balance 2,49,000. Now additional information, closing stock was valued at rupees 35,900. So that we will credit to trading account and it will come as an asset in the balance sheet. Two adjustments since it's appearing outside the trial balance. Second is provide rupees 1,000 as bad debts. So this also two adjustments. One is it will be debited to profit and loss account. Second is it will be subtracted from the debtors in the asset side of the balance sheet. So trading and profit and loss account of Mr. H as on 31/3/22. To opening stock 52,000, to purchases 89,000, less returns 1,200. So outer column 87,800. Now credit side by sales 1,30,000, less returns 2,000, outer column 1,28,000. By closing stock 35,900. Now you can see that credit side is higher, that is 1,63,900. When you balance, you are getting 24,100 as the gross profit. This we will transfer to profit and loss account. So gross profit brought down in the credit side 24,100. By discount received 700. Now debit side to bad debts 460. Add further bad debts 1,000. So bad debts already adjusted in the trial balance is 460. Further bad debts mentioned outside the trial balance is 1,000. So outer column 1,460. To salaries 9,500. To trade expenses 4,100. To carriage. Just if it's carriage inwards, you know that it will go to trading account. Just carriage meaning it will come in the profit and loss account. The value is 1,000. To insurance 440. To rent, rates and taxes 7,100. So when you balance it, credit side is higher 24,800. The difference is 1,200. That is the net profit transferred to capital account. Now the balance sheet of Mr. H as on 31/3/22. Capital 70,000, add net profit 1,200, total is 71,200. Less drawings 2,900. So outer column 68,300. Creditors 39,200. Bank overdraft 7,900. Now in the asset side, fixtures and fittings 3,700. Machinery 5,000. Debtors 71,500. Now you have to reduce the new debtors given outside the trial balance from debtors. So bad debts 1,000 you are reducing. So outer column 70,500. Closing stock 35,900. Cash in hand 300. So total of the balance sheet is 1,15,400. So now we will come to the second topic of this module, that is provision for bad and doubtful debts. Now, what is provision for bad and doubtful debts? From their day-to-day experience, they will have a certain percentage. They know that every business firm will know that this much percentage will go as bad and doubtful debts. So that certain percentage is kept as reserve. So that is the provision for bad and doubtful debts. Sometimes they may be able to collect it. Sometimes they may incur more than the provision. So one reserve, what they have decided is the old reserve. So certain percentage from their experience, they have realized this will be the amount to be kept as reserve. That is the old reserve. Now you have to remember that when they prepare the trial balance, they will come to know that there is a need to increase the provision. So what they will do, they will provide outside the trial balance a new provision. The new provision mentioned outside the trial balance is called the new reserve. So it's very important, old reserve and new reserve. In the problem also you can see that adjustments are related to old reserve and new reserve. So now this is an important adjustment. Certain points you have to remember. So bad debts, if it's mentioned in the trial balance, only debited to profit and loss account. There is no other adjustment because it will come only as one adjustment. Only when it's coming outside the trial balance, it will have, you have to adjust two adjustments. Now further bad debts mentioned in the adjustments. So it will be added to bad debts already given in the trial balance plus debited to profit and loss account. Now, new bad debts mentioned in the adjustment is subtracted from debtors in the balance sheet. So, two adjustments. One is already existing debtors in the profit and loss account. This new debtors will be added and debited to profit and loss account. Second is whatever the new debts, bad debts mentioned outside the trial balance, that will be subtracted from debtors in the balance sheet. Now we are coming to the provision. New bad debts provision mentioned in the adjustments. New provision, how it's calculated is important. New provision is calculated after subtracting the new bad debts mentioned in the adjustments from debtors. I told you new bad debts when they will mention outside the trial balance, that will be subtracted from debtors. That value only we will calculate the new provision. New provision percentage will be mentioned 5%, 10%, 2%, etc. So now you know that there is an already an old provision. Old provision will be mentioned in the trial balance. So the old provision is there and the new provision is what you calculated. It is mentioned as a percentage outside the trial balance. So the difference between old reserve and new reserve is debited to profit and loss account, and provided the new reserve is more than the old reserve. The new reserve is also subtracted from debtors in the balance sheet. So two new adjustments, bad debts, new provision, how you calculate, whatever new bad debts given outside the trial balance will be subtracted from debtors. On that value only you will calculate the new provision. Always students will make mistakes, so please remember that. Then you have to remember the new bad debts mentioned outside the trial balance and the new provision. Both has to be subtracted from debtors in the balance sheet. So these adjustments are important. So the second problem, this is not a trial balance. From the following account balances of Mr. J, prepare the final accounts as on 31/3/22. Trade creditors 35,780. Bills payable 18,700. Legal expenses 420. General expenses 7,580. Cash at bank 18,980. Capital 1,69,200. Premises 40,000. Loan 40,000. Returns outward 16,200. Bad debts provision 2,200. This is the old reserve. Cash in hand 400. Discount allowed 8,600. This should be debited to profit and loss account. Manufacturing wages, this should be debited to trading account 39,940. Discount received 5,800. Bills receivable 5,360. Purchases 1,17,200. Stock 63,900. Debtors 63,220. Carriage inwards 3,580. Returns inwards 28,600. Now, salaries 15,700, bad debts 2,600, plant and machinery 59,000, sales 1,98,400, rent, rates and taxes 11,200. Now, additional information, closing stock is valued at rupees 93,840. Provide further bad debts rupees 2,910. Provide provision for debtors at 5% of debtors. Now, trading and profit and loss account of Mr. J as on 31/3/22. To opening stock 63,900. To purchases, inner column 1,17,200 less return 16,200. Outer column 1,01,000. To wages 39,940. To carriage inwards 3,580. By sales 1,98,400 less returns 28,600. Outer column 1,69,800. By closing stock 93,840. Total of the trial balance is 2,63,640. When you balance it, debit side you will get a gross profit of 55,220. Now, by gross profit brought down 55,220, by discount received 5,800. Debit side, to legal expenses 420, to general expenses 7,580, to discount allowed 8,600, to salaries 15,700, to rent, rates and taxes 11,200, to bad debts 2,600, add further bad debts mentioned outside the trial balance 2,910. So outer column 5,510. Now, bad debts provision. Old one is mentioned in the account balance 2,200. New provision 3,016. So how you calculate? From the debtors you will subtract 2,910. On that value you will calculate the new provision mentioned outside the trial balance. So 3,016. So the difference will be debited. New provision is higher. So they realize that more provision is required than what they have already provided. So 816 rupees. So net profit transferred to capital account is 11,194. This we will add to capital. So capital inner column 1,69,200, add net profit 11,194, outer column 1,80,394. Creditors 35,780. Loan from bank 40,000. Bills payable 18,700. So 2,74,874 is the liability side total. Same total we have to get for the asset side also. Plant and machinery 59,000. Premises 40,000. Bills receivable 5,360. Debtors 63,220. Less further debtors 2,910. This is the value which was appeared outside the trial balance to provide for debtors, bad debts. So 60,310. Now the new provision 3,016 again you have to subtract. So two subtractions. One is the value of extra bad debts mentioned outside the trial balance and the new provision. New provision again I am repeating. New provision you will calculate from 60,310. That is debtors minus further bad debts. So the outer column value 57,294. Cash in hand 400. Cash at bank 18,980. Closing stock 93,840. So total of the asset side 2,74,874. So two adjustments we have learned in this module. Both are very important. One is bad debts and second one is provision for bad and doubtful debts. So bad debts, it will appear outside the trial balance. So it will be debited to profit and loss account, subtracted from debtors in the asset side of the balance sheet. Provision for bad and doubtful debts. New provision is there which is appearing as an adjustment in the trial outside the trial balance. So that you will calculate after subtracting from debtors the additional bad debts required. which is out appearing outside the trial balance. So old provision and new provision. If new provision is more than the old provision, then that value also will be debited to profit and loss account. Then two values you have to subtract from debtors, new bad debts mentioned outside the trial balance plus the new provision. So this is very very important adjustment. Students usually make mistake in this. Please take care. Happy learning. Thank you. This is what I want to explain in this module. Thank you.